I'm here at the NASDAQ market site in New York with Dr. Robert Hartwig, President and CEO of the Insurance Information Institute. Welcome back to the program, Dr. Hartwig.
Glad to be back.
The recent announcement of JP Morgan's $2 billion loss shook confidence in the financial industry, and again, we're hearing more calls for regulation. Can you break down the JP Morgan loss for us and explain the impact that has on the insurance industry?
Well, there are a couple of dimensions to the JP Morgan loss. First of all, it was quite a surprise to everyone, including CEO Jamie Dimon himself. It was an extraordinary loss, more than $2 billion, and it comes at the worst possible time for the financial services industry, some segments of which have been campaigning and lobbying against the full implementation of the Dodd-Frank Act of 2010, and specifically the Volcker rule, which has been much in the news recently, which would prohibit financial firms from trading on their own accounts. Certainly in this particular case, there's a question about whether the Volcker rule would have prevented exactly what happened at JP Morgan Chase. JP Morgan Chase says it's not applicable. The White House is already saying that we need to, this is proof positive that we need more stringent regulation. So the SEC is undertaking an investigation. There's a lot more to be said and a lot more to be learned about this particular event. But in terms of exposure to the insurance industry, there's not really much in the way of a direct exposure at all to insurers. First of all, insurers aren't really engaged in this type of activity on their own. Second of all, the sorts of things that JP Morgan was engaged in didn't really involve insurance to any real respect, in any respect at all. So I would say that if there's any exposure at all, who knows, when share prices fall in a particular sector, sometimes that can generate interest on the part of shareholder suits. We'll have to see where that goes. It's too soon to tell.
Now I'd like to talk about the global economy, Europe in particular. Recent elections in France and Greece suggest a change in direction on austerity measures imposed by the EU. What's next?
We've had 12 out of the 17 European Union countries actually choose new leadership over the last several months. France being the most recent. We saw Italy, we saw Greece, and we have other issues in some other countries as well. There is an increasing sense that the austerity measures that have been imposed by particularly the Germans and those who hold the purse strings in Europe are just too severe for some of the participants in the EU, particularly Greece. The Italians aren't happy with it. The Spaniards look increasingly unhappy with it. And so people are looking perhaps for some easing up of these austerity measures. Now, what that means, however, is these countries could rack up more debt, and they're going to need more cash infusions, not only from countries like Germany, but the IMF, the World Bank, and potentially others. So we're going to have to see where we're going to go. Looks like we're going to see a long, hot summer of uncertainty in Europe with respect to the euro and the eurozone. I don't expect the euro to fall apart. I think it is increasingly likely that Greece will be ejected from the eurozone. However, that can occur in an orderly fashion, and it need not mean that other countries like Italy, Spain, Ireland follow suit.
The so-called shareholder spring appears to have forced Aviva's CEO to resign just last week. Have shareholders made their point, or is this just the beginning of a sea of change?
Well, shareholders seem to be just about as unhappy as the voters of Europe as of late, and it's possible we could see more shareholder revolts against, in particular, executive compensation, which is really a reflection of underperformance in terms of share prices, generally speaking. So it seems that this particular movement has some momentum, at least in Europe, and so we may not yet have seen the last of it.